Imagine being able to wake up every day without worrying about money. That was the reality for Sarah after she embarked on her journey to financial freedom. Sarah's journey was not an easy one. It was a path strewn with obstacles and challenges that tested her resolve and determination. But she didn't give up. She decided to face her financial worries head-on and took steps to gain control over her finances. Sarah began her journey by educating herself about financial matters. She read books, attended workshops, watched online tutorials, and even took a course to understand the different types of investments, their risks, and potential returns. The more she learned, the more confident she became in making informed financial decisions. Next, she set clear, achievable financial goals. Whether it was saving for her retirement, buying a house, taking a dream vacation, or even just building an emergency fund, her goals gave her a direction and a purpose. They helped her stay focused and motivated as she worked towards her financial freedom. Sarah knew the importance of diversification in her investment portfolio. She didn't put all her eggs in one basket. Instead, she spread her investments across different asset classes such as stocks, bonds, real estate, and mutual funds. This strategy not only reduced her risk but also gave her the potential for higher returns over the long term. She also learned to resist the temptation of short-term market fluctuations. Sarah understood that the most successful investments are those made over time. She stuck to her investment plan and maintained a long-term perspective, even when the market was volatile. When it came to managing her debts, Sarah created a detailed budget. She identified her expenses and income, cut down on unnecessary spending, and prioritized paying off her high-interest debts. She even considered consolidating her debts into a single loan with a lower interest rate. And when she felt overwhelmed, she reached out to her creditors and negotiated for lower interest rates or alternative payment plans. Sarah's story is not an anomaly, but a possibility that can become your reality. Let's explore how. Before you start investing, it's crucial to understand the landscape. Financial education is the cornerstone of sound investment decisions. It's about understanding different types of investments, their inherent risks, and potential returns. It's about knowing how to read market trends, decipher financial reports, and make sense of economic indicators. There's a plethora of resources available to help you acquire this knowledge. From classic investment books to online courses, from finance blogs to podcasts, the wealth of information is vast and accessible. Each of these resources can provide you with unique insights into the world of finance and investing, helping you to make informed choices. And remember, financial education isn't a one-off event, it's a lifelong journey. Markets evolve, new investment instruments emerge, and economic scenarios change. As an investor, your learning never stops. Knowledge is power, and in finance, it's the driver of profitable decisions. Investing without a goal is like sailing without a compass. It's a journey with no destination, a race with no finish line. Just as a sailor uses a compass to navigate the seas, you need clear, specific, and achievable financial goals to guide your investment decisions. Think of your financial goals as your personal North Star, a beacon guiding you through the complex world of investing. Whether it's saving for retirement, buying a house, traveling the world, or building an emergency fund, your goals give your investment journey direction and purpose. But remember, it's not just about setting goals, it's about setting the right goals. Goals that are specific, measurable, achievable, relevant, and time-bound. These SMART goals can serve as your investment roadmap, helping you make informed decisions, track your progress, and stay focused on your journey to financial freedom. Your financial goals are your investment roadmap, guiding you towards financial freedom. Don't put all your eggs in one basket. This old adage holds particularly true when it comes to investing. This principle is known as diversification. Essentially, diversification is about spreading your investments across different asset classes to mitigate risk. Imagine you're on a rocky boat. Investing in only one type of asset is like standing on one leg. It's unstable and you could fall at any moment. Diversification is like standing on both legs, offering you stability and balance. By investing in a mix of assets like stocks, bonds, real estate, and mutual funds, you're essentially cushioning your financial portfolio against unforeseen market downturns. If one asset class doesn't perform well, it's likely that another might do well, offsetting the loss. It's all about balance and resilience. So, how's your investment portfolio looking? Is it balanced on one leg or standing firm on both? Remember, diversification is your hedge against risk, ensuring your investment portfolio is balanced and resilient. Rome wasn't built in a day, and wealth isn't built overnight. It's an old saying, but it rings true, even in our fast-paced, instant gratification world. When it comes to investing, one of the most effective strategies is playing the long game. Long-term investing comes with a multitude of benefits. It allows you to ride out market volatility, smoothing out the peaks and valleys of stock market fluctuations. It also gives your investments time to compound, which is a powerful tool in wealth creation. Now, there's a danger in trying to predict short-term market movements. It's a game that even seasoned investors often lose. The market has a mind of its own and can be influenced by a myriad of factors. Instead, focus on consistency. Regular, disciplined investing, regardless of market conditions, typically yields better results over the long run. So remember, in investing, patience isn't just a virtue, it's a strategy. To manage your money effectively, you need to know where it's going. This is where the art of budgeting comes into play. It's not just about tracking every penny, but about understanding your financial habits. Creating a detailed budget is a powerful step towards financial freedom. It involves listing all your income sources and expenses, from your morning coffee to your monthly rent or mortgage. This process can be eye-opening, highlighting areas where you're spending more than you thought. Once you've identified these areas, you can start to make changes. Maybe you discover you're eating out too often, or your subscription services are adding up. By reducing these expenses, you can free up more money to pay off debts or contribute to your investments. Remember, a budget isn't about deprivation. It's about making conscious decisions about where your money goes. In the end, a budget isn't a restriction, but a tool for financial freedom. Not all debts are created equal. Indeed, some debts can grow exponentially due to high interest rates, while others remain relatively stable. That's why it's crucial to prioritize your debts when planning your repayment strategy. The first step is to make a comprehensive list of all your debts. Write down everything from your credit card balances to your student loans. It's important to note the interest rates for each debt as well. Once you have this information, you can start to prioritize. Debts with the highest interest rates should be your first target. These are the debts that can balloon quickly and consume your finances. While you focus on these, continue making minimum payments on your other debts. This strategy, often referred to as the avalanche method, can help you reduce the total amount of interest you'll pay over time. So, prioritize your debts, tackle them smartly, and watch as the path to financial freedom becomes clearer. Tackling debt strategically can set you on the fast track to financial freedom. Sometimes it can be beneficial to put all your debts in one basket. This statement might seem counterintuitive, but when we talk about debt consolidation, it makes perfect sense. Debt consolidation is a strategy that involves taking out a new loan to pay off multiple debts. This new loan often comes with a lower interest rate than the individual debts, making it a potentially cost-saving move. Not only can this strategy lower your overall interest rate, it can also simplify your financial life. Instead of juggling multiple payments, due dates, and creditors, you'll have just one monthly payment to remember. This can reduce the stress and confusion that often come with managing multiple debts. But remember, debt consolidation isn't a magic bullet. It's a tool that needs to be used responsibly as part of a larger debt repayment strategy. It's not about creating new debt, but about managing existing debt more efficiently. Debt consolidation can be a powerful tool in your debt elimination arsenal. In the world of debt, your voice matters. It's an arena where negotiation can serve as a powerful tool. It's not uncommon for creditors to be open to discussions about lowering interest rates or setting up alternative payment plans. The key here is communication. Reach out to your creditors, express your commitment to paying off your debt, and discuss your current financial situation. Often, they're willing to work with you rather than risk non-payment. You might be surprised to find that they're open to adjusting your interest rates or extending your payment period, making your debt more manageable. Remember, creditors are people too, and they understand that life can throw unexpected curveballs. They're usually more flexible than you might think, so don't hesitate, don't feel embarrassed. And most importantly, don't be afraid to ask for help. Negotiation can turn the tides in your favor, helping you take control of your debt. The journey to financial freedom may be challenging, but it's not impossible. Let's recap what we've covered today. Financial education is the bedrock of this journey. Understanding different types of investments, their risks, and potential returns. But knowledge without action is futile, hence the importance of setting clear, achievable financial goals. Diversification is your shield in the unpredictable world of investments, spreading risk across different asset classes. Remember, the most successful investments are those made for the long term. On the flip side, managing debts requires a meticulously crafted budget, understanding where every penny goes. Prioritize your debts, focusing on those with the highest interest rates. Consider debt consolidation to simplify payments and potentially save money in the long run. And don't forget, negotiation with creditors is always an option. With determination, discipline, and these strategies, you too can achieve financial freedom, just like Sarah.